You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everybody. The bond market is being waterboarded, and as a result of raising rates here in the U.S., and now it's starting to affect the stock market. So that's what we're going to be talking about today. But first, as always, a few housekeeping items. If this is your first time listening or watching, then thank you for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope's for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So please come back often. Feel free to subscribe on both iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koos and on Instagram at Financial Surgeon. And last but not least, all links, visuals, charts, and other educational resources are available on our website. We're going to be looking at some comparative or relative comparative charts, looking at bonds today. We're going to be looking at a few stock charts today. So that will be available online if you want to look at it later, but I'll be talking you through all the information if you're listening on iTunes today. So let's go ahead and get started. As always, I like to start with a quote, and today's quote is Warren Buffett. He said, "Diversification is protection against ignorance." So we need to stay focused on the leaders when we're investing. We need to, in my opinion, I should say, let me qualify my statement. We need to stay focused on the playoff teams. If every investment that we could buy in the entire world was one of the 32 teams in the NFL playoffs, then we wouldn't want to just equally invest our money in all 32 teams. As much as I love my Cleveland Browns, there would have been about 20 to 25 years where we would have just been losing money hand over fist. So diversification across all asset classes, sectors, industry groups doesn't necessarily make sense. So, and you're hearing this from the Oracle of Omaha, as he's called, in Warren Buffett. I think he knows a thing or two about investing. So today we're going to be talking about is first of all, just the volatility that we've been seeing in the market. Bonds, they've been beaten up pretty badly since Election Day. Now, there are some bond sectors, and there's ways that we could have been making money during this past, call it 3 months or so since Election Day, in different bond categories, sectors, whatever you want to call it. And we can talk about those as well. We did a podcast last week, actually, where I went over all the different types of bond sectors, or most of them, I should say. And if you want to check out that podcast, you'll just go into our either YouTube or iTunes page, go back into last week's, and you'll see that we go over a bunch of different sectors and different ways that you could invest in bonds outside of just buying, say, U.S. Treasuries, corporate bonds, munis, and so on. So there's places we can make money in the bond market, but bonds have been generally struggling, and the reason for that is because in the short term anyway, this past several months, interest rates have been rising. In fact, interest rates on the 10-year Treasury has popped to a point not seen in quite a while, well over a year at this point. And what's now happening as a result of rates going too high is we're starting to see the rising rate environment scaring the stock market. One of the reasons that happens is because as interest rates go up, obviously people can lock in guaranteed, if you want to call it that, interest backed up by the full faith of the U.S. government on very, very safe short-term debt. Let's just say U.S. Treasuries, paying 1.6, 1.5%, which might not sound like a lot, but when you compare that to what rates looked like, say, back in March when they were worthless, all of a sudden you kind of start to see some of that maybe risky money being moved over to some conservative assets. And what happens, obviously, it's supply and demand. When there is more selling pressure than buying pressure, then price must fall. And if there's more buying pressure than selling pressure, then price must rise. So if you start to see some selling out of the bond market, then so when you start seeing rates rise, you'll see some selling out of the stock market as people go searching for that yield and that safety. And that causes, obviously, downside pressure on the stocks. Rising rates are one issue, but the other issue that I'll talk about a little bit later, and I'll show you on a chart for those of you watching on YouTube, is that the more selling there is, the more selling you get. So selling breeds selling, especially when you're talking about things like exchange-traded funds or mutual funds. Now, we don't use mutual funds at our office. We use individual stocks and ETFs. But when you have an exchange-traded fund, or ETF for short, that is seeing a lot of selling, so in other words, individuals, institutions are selling that exchange-traded fund, eventually they have to sell stocks in order to give you your money back. Now, they always have typically some cash reserves on hand for people who, on a day-to-day basis want to sell, but we run into a problem when you start seeing so much selling that the ETF managers or the people running the ETF have to actually start selling the underlying stocks in that ETF to generate cash so you can get your cash that you want for selling. Because obviously what that does is the more they sell, the more it sends the value of those stocks down, the more it sends the value of the ETF down. And of course, as those stocks, depending on the kind of ETF it is and depending on the stocks in question, can affect the S&P 500, the NASDAQ, the Russell. So you can start seeing it, the Dow. You can start seeing this kind of domino effect occur across the market landscape as selling breeds more selling. And then we're going to look at some sectors here as well. But let's look at the bond market first. And this is what I was talking about earlier when I say since election day, and this is, I know it's kind of a messy chart, it looks like, kind of like a spider web or whatever, but each one of these lines that you're looking at here is a different type of bond. We've got Treasury inflation protected securities here. We've got emerging markets bonds, credit bonds. We've got zeros, so zero coupon bonds here. We've got long-term treasuries. And you can go right down the line here. And for those of you that are listening on iTunes, since election day, we've got high yield here at 2.2%. HYG is the symbol. And then you've got municipal bonds right now sitting at zero, basically flat since election day. But everything else is down. We've got 1.2%, down 2.5, down 2.7. Down 4.7. We've got, this is TLT, so 20-year Treasury bonds down 11.5% since election day. And then zero coupon bonds. Again, these bonds are typically considered to be safe investments. When people think bonds, especially government bonds, they think safety, they think security. But zero coupon bonds since the election are down 15%. So, and again, that's because interest rates are going up. And let me pull up real quick here the TNX, the 10-year Treasury note, and you can see on this chart here, so how the interest rates bottomed out. You could say right over here on March 9th, the 10-year Treasury bottomed out. Looks like we closed at around 0.49, call it 0.5% on the 10-year Treasury. It bounced during the Corona rebound, fell back down again and kind of chopped sideways. And then we kind of saw another low in interest rates right in the early part of August. Again, right around that 0.5% range or just a little bit higher. Now, since August, generally speaking, we've seen an uptrend in interest rates, specifically here on the 10-year Treasury note. Now, when people think 10-year Treasuries, usually they're comparing it to things like mortgage rates. When mortgage advisors are looking to lock in rates, a lot of the times they'll be paying attention to the 10-year Treasury to determine, what rate you might get on a mortgage. It's not tit for tat, but I just wanted to share that. But you can see right here, we're at a point right now where we're sitting right around 1.51, 1.52% on the 10-year Treasury. And I'm going to draw this backwards here. And as you go back in time, and this is going to go back all the way to, let's see here, July 17th, July 19th of 2012, was the last time in the last decade, we'll say, we can go back there and we can see the first time rates hit that 1.4% mark was back in July of 2012. It bottomed and came down to that 1.4, 1.3.5, so 1.35% level in July of 2016. So that was 4 years later. And then it cracked through that 1.4, 1.3% level during the Corona crash and stayed below there until, again, just literally this past week, we've seen interest rates on the 10-year Treasury climb back above that level. So that's what's not just the 10-year Treasury itself, but that kind of price action and yields, or the rising in interest rates and in Treasury yields, is what's causing some of these issues with the stock market now. So it goes without saying that it's been hurting the bond market, because as interest rates go up, bond prices go down. But now what we're seeing is as interest rates go up as fast as they have in the short term, we're starting to see that putting a little bit of pressure on the stock market. And that's what I was going to show you here with the NASDAQ. You can go back here on your screen if you're watching on YouTube or on iTunes. When you go back to February, March of 2020, we had obviously the Corona crash. I'll turn off my cursor here. And we had obviously huge record-setting 22-day drop, 34, 35% drop in 22 days in the stock market, and then the market spent all that time underwater. We saw a little bit of time underwater here. If you fast forward to September of 2020, and the market started looking like it might correct, and it did. It wasn't a big correction. We're talking about, let's see here, if I start at the top and go down, we're looking at maybe like a, that's not right, hold on. Turn my crosshairs back on here. So let's see, we closed September, bottomed out at, on the NASDAQ, it looks like a drop of about 12.7%, so that would definitely be a correction. And then we saw another topping process here. Looks like Monday, October 12th, the market topped out, closed the next day right around the same point, and then between then and we'll call it, let's see, October 30th, so Halloween of 2020, market dropped 8.5%, and since then it's been a pretty steady uptrend. Right up until recently, we saw a pretty big drop, and now the NASDAQ's back underwater again. And as I've said in the past, the stock market indices, major market indices like the NASDAQ, the S&P, they can spend some time underwater, but eventually, once you spend too much time underwater, you can run into trouble where all of a sudden your portfolio is drowning. And I'll go back to 2007, 8, and 9 as our first example of this. And you can see here that from, and I'll pull up the S&P 500 actually, so SPY. If we go back to 2000, let's see here, October of 2007. And then, so here's October of 2007. This is the top of the stock market. And then over the course of the next 18 months, the market went down about 57, almost 58%. But you can see how the market generally spent most of its time below its 50-day moving average, which is what you're looking at in the area and the blue line here. And I've made it blue because I like to call it underwater for my fun little analogy. But there was a very short period of time here between April and June of 2008 where it bounced, but generally speaking, again, it spent most of its time underwater below its 50-day moving average in a downtrend. And if you're wondering, by the way, I'll go back to the NASDAQ real quick here. If you're wondering what these colors are, the blue and red at the bottom here, I use blue and red because I'm colorblind. But this is the percentage that the index is below or above its 50-day moving average. So it's a really easy way to see, what percentage below that 50-day are we. And right now, as I'm talking and recording this podcast, we're about 1.5%, 1.6% below the 50-day moving average. And if you go back to October, we were down around 4% below at its bottom, and then 3.5% at its bottom back in September. So we don't really know how bad it can get. Obviously, if we look at the Corona crash, this thing was down, let's see here, about 22% below its 50-day moving average. So in tactical portfolio models, we have both. We have both strategic, call it buy and hold, sector rotation models. We also have tactical models, and in a tactical model, tactical portfolio management, trend following portfolio management, we'd want to be being pretty darn cautious at this point now that we're sitting here underwater until we start to see things improve a little bit. So I mentioned selling breeds selling. I'm going to pull up Cathie Wood's, let's see here, ARK-K. So the ARK Innovation ETF, this is going to update in a second here, as soon as it pulls the data in from TD Ameritrade. But you can see here how we've got this, drop below underwater. It's a gap down technically. In fact, let me zoom in. Last week, on Monday, I should say this week, the market closed down and this ETF closed down. It's a innovation ETF managed by Cathie Wood. A lot of technology inside the ETF, and then it gaps down below its 50-day moving average or underwater, and then it tries to climb back above it but can't, gaps back down again the next day and closes low. And here we are today on Friday, very solidly below the 50-day moving average, or in other words, below, call it underwater. And right now, it's just, again, what we have is this situation where you have people selling the ETF, and as they sell the ETF, they have to sell the stocks inside the ETF, and when they sell those stocks to give those investors their money back for selling the ETF, now all of a sudden that causes the stocks to go down in value, which causes the ETF to go down in value even more. So again, it's that domino effect when I look at this chart, what I see here is a potential floor of support right here going back to the December lows, which also corresponds with, call it, a little bit of congestion and sideways movement back here in early December. But at the same time, as long as we're underwater, as long as we're starting to see heavy selling like this, and when I say heavy selling, whenever you see big, huge, hollow candles, this is a candlestick chart, so this big, huge empty candle back here, like on January 7th, we have market gaps up, it opens higher, and then it closes really high. That's a nice big bullish candle. It's a positive sign. When we see the opposite, a dark, heavy, filled, lead-filled candle like this, or even the one looking at Monday was pretty dark in itself. So we get a black candle means the market opened at the top and closed at the bottom, and we've seen two pretty negative candlesticks here, all below now the 50-day moving average, which again is a sign of weakness. So that's that. Now the last thing I wanted to share with you today, and by the way, as I get over to this other workbook, I want to let you know I'll be writing a market commentary this weekend, so a written commentary, that is. So I'll be going over a little bit more of this information and more in written form over the weekend for those of you who would rather read than watch or listen. And if you're not on that list, if you don't get our market commentary currently, just head over to our website and sign up. Or you can reach out to us at info@libertaswealth.com and we can throw you on the list. But let's finish up today by going over all the different sectors here in the U.S. market. And this is a relative rotation graph, so we call them RRGs for short. Julius DeCamponaire, a good friend of mine, he invented this back in probably the late 2000s, but brought it to Bloomberg in 2011, and it's become, in my opinion, the best way to prove that sector rotation and this concept of staying with the playoff teams and staying with strength makes a whole lot of sense, because when you look at this chart here, the upper left quadrant up here on the left is improving versus the market, improving versus the S&P 500 in this case. Upper right is beating the market or leading the market, outperforming the market. Bottom right would be weakening, and then lower left would be lagging. If I take this backwards, you can see there's kind of this clockwise rotation that exists, and that's just typical of an RRG. When you look going back in time, we could look, there's many studies that have been done, but one in particular that I like to focus on is one where roughly 68 to 70% of the time you tend to see this rotation in a clockwise fashion, which means that stocks, sectors, industry groups have a tendency to lag the market, then move to improving, then leading, then weaken, and then go back to lagging again on an ongoing basis. There's no perfect science to it. Typically, when you look back at studies, investments that tend to outperform the market over the last, call it 3 to 12 months, tend to outperform over the next 3 to 12 months. Those investments that tend to outperform over the, say, last 2 to 3 years have a tendency to underperform over the next 2 to 3 years. But again, I want to reiterate that that's not investment advice. This is not a science. These are studies that have been done on relative strength. So what I'm seeing here on this relative rotation graph is, first of all, we're seeing staples and utilities in the lagging quadrant, which means that they're lagging the market. They've been underperforming. And the tail of this arrow tells us where it's been. And you can see how, in the case of consumer staples, we've been moving toward the lagging quadrant, even deeper into that lagging quadrant, and while utilities is kind of pointing northward toward the improving quadrant, we're still seeing it sit in the lagging quadrant, and it's not pointing northeast. I like to see strong sectors moving out of the lagging or improving quadrants, pointing northeast toward the leading quadrant, technically. And then, of course, it goes without saying that those investments that are leading the market right now are things like energy. To go a step deeper, I would say small cap energy is doing really well. Financials are doing well. As interest rates have gone up, that helps financials. And even though materials are weakening right now, materials have been a pretty decent sector to be in. But technology's been what's taken the hit. This is every one of these dots that you see here on these arrows in this relative rotation graph is 1 week. So right now what we're seeing is this big jackknife in the technology sector, jackknifing south, and to the lower left quadrant, which is obviously not a good sign for technology. Of course, the question is it going to hold? Are we going to continue to see this rotation out of growth and tech into things like financials, energy, maybe even real estate? You can see is kind of, for those of you on iTunes, the real estate sector has moved out of the lagging quadrant. It's in the improving quadrant, and it's pointing northeast. Those are all good things. So something to kind of keep in mind, something that's on my watch list, obviously, is real estate. So I think that's probably good for today. I'm just going to close up by saying that the stock market right now is, in the short term, the trend is down. The bond market looks really rough right now, although I think that we could be reaching a point here in the not too distant future where we should see, I shouldn't say should, where we could see interest rates start to peak out. And as interest rates peak out and maybe in the short term start to revert back to mean, if that were to happen, that would not only help kind of dampen some of this concern about high rates in the stock market, but it would also help to start to bring the bond market back, where we'd start seeing some of these things like long-term treasuries, intermediate-term treasuries, and some of these other bond categories start to improve and come back around and start to make up for some of these losses, in some cases deep losses that we've seen recently. So with that all said, that's it for today's show. Please feel free to share this episode with your friends and family. If you'd like to discuss your personal situation further, your portfolio, retirement plan, please remember that you never ever have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, you can just head over to our website on the contact page, and you can schedule something in our calendar. You get access to our calendar there, or you can just reach out to us personally at info@libertaswealth.com. And as I always say, there's thousands of podcasts out there. Obviously, you chose to give ours a listen today, so thank you so much for tuning in. Please be sure to subscribe on both iTunes and YouTube. And remember, you can sign up at libertaswealth.com to not only get these updates for podcasts, but also other screencast videos, articles, and other material that we put out directly to your email inbox on a regular basis. Feel free to follow us on Facebook at facebook.com/LibertasWealth. I'm also on Twitter at Adam Koos and on Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.